Resources. That's the economic update. And we are lucky today to have another one of Wells Fargo's finest with us. Michael Wolf is an economist with Wells Fargo Securities, covering both U.S. and regional economies. Based in Charlotte, North Carolina, he writes indicator reports, special commentary, and contributes to the company's weekly economic and financial commentary. Prior to joining Wells Fargo in 2013, he worked as a regional and international economist for Moody's Analytics, and he also measured trends in compensation as an economist for the Bureau of Labor and Statistics at the federal government. Michael has master's degrees in both international economic policy and statistics from Columbia University and Baruch College, respectively. He also has an undergraduate degree in economics from the University of Maryland. He is a member of the National Association of Business Economics and the Charlotte Economics Club. Please help me welcome Mike Wolf.
Great, economics. This is the last one, right?
Yeah.
It's really exciting one to start off with. Try this. Can you hear me? Yeah. All right, so I'm going to talk a lot about the national economy first, and then talk a bit about North Carolina. But I want to start with the U.S. Mostly because you can get a level of detail about what's happening in the U.S. economy that you can't see at a state or local level. So just a couple of things that have been happening, from the national perspective, is that for the first quarter of 2014, we got this one very negative reading for GDP, negative 2.9%. And I think a lot of people are really troubled by that number, and probably rightfully so. So I just want to highlight a couple of reasons why we're not that concerned about it, and why we're projecting here those green bars to the right, that we are sort of positive moving forward. So a couple of things just to note. One is, the negative reading was a couple of things, but the two biggest negatives were exports, net exports, and inventories. So we had this really sort of improvement in our trade position at the end of 2013, and we got payback for that in the first quarter, so that was a net negative. And we also had a big inventory build at the end of 2013, and then again payback in the first quarter. And there were a couple other things that I'll highlight in a minute. But so, largely, again, we think, yes, negative number for the first quarter, a lot of temporary factors, don't be alarmed, we're still okay. So this is the point where I usually say, I'm going to talk about good things and bad things in the economy, and then I say, oh, bad news, and I flip to the government side, people laugh. I think this may be the setting where that's not so funny. And I think actually, it's actually not so bad anymore. So we're forecasting some positive growth coming out of the government sector finally. When we were doing this a year ago, we were pretty much right around the zero mark coming out of the public sector. And so there's been some good news and bad news. The good news has actually come from the state and local level. We're actually getting a little bit of hiring coming out of state and local governments. But the federal government continues to be a bit of a problem. And so here's the federal deficit. It's still $490 billion in the red. And I think quite a bit more problematic isn't so much the deficit, but that we don't really have this long-term plan to get the deficit into a surplus. So this is the CBO's projection of our budget gap. So the top line are our government expenditures, and the blue line is revenues. So even in the last, over the next 10 years, we never get to a point where we have revenue reaching expenditures. So moving forward, what this really means, I think, to us as economists is that do whatever you want as a government, but the problem here is that we see the U.S. government as being a net drag on overall growth, because at some point they're going to have to cut expenditures, raise taxes, or do some sort of combination, right? And so both of those policies end up being contractionary to overall growth. So, state and local government looking a bit better, federal government continuing to be a net drag moving forward. All right, so businesses. Business investment happened to be one of the other net negatives in the first quarter. And again, we think this is temporary. I know this kind of sounds like, no, don't worry, and then everything falls apart. But I really do believe that this was just a temporary factor, largely to blame for the weather. I know that seems silly, but there were a lot of supply disruptions that happened over the winter. I think looking at all those pictures from Atlanta during the snowstorm and sort of just how much disruption there really was over the winter. I think a lot of that has to do, a lot of this negative rating has to do with that. But overall, business investment isn't exactly strong, and we don't expect it to be really all that strong moving forward. Thank you. So I think, again, sort of countervailing measures in the world of business fixed investment. On the positive side, non-financial corporations are holding on to record amounts of cash on their balance sheet. So we think that businesses actually have the, sort of the capability of investing more, but they're just not doing it, right? And I think the key thing that's really holding them back is sort of doubt, right? They're not particularly optimistic about where the economy is going. And I think that's been especially true for small businesses. So here we have the National Federation of Independent Businesses. They did a survey, and it's, they go around and ask small businesses, how they're feeling about the economy, and one of the things that they ask is, what's your biggest complaint? And so the top three end up being taxes, regulations, and core sales. So the good news is that, the share of businesses that have been saying core sales, you can see, has been declining considerably. And I think also not such bad news is that taxes is the #1 complaint, right? Like if you had nothing to complain about, you had to complain about something, you would probably complain about taxes. But I think regulation ends up being a very real and sort of justifiable complaint, right? Particularly for small businesses, you have, whether you agree with them or you disagree with them, but you have the Affordable Care Act, you have Dodd-Frank, you have a number of different large policies that are coming your way. As a small business, it's difficult for you to sort of navigate that, and it ends up being a burden on you as a small business owner. So I think that on some level has been a hindrance to them to know really where to invest and sort of what else is coming down the line. Again, moving back to the future of federal deficits, where do future cuts come from? Where does future revenue come from? And I think as a business owner, you're sort of saddled with this uncertainty, and I think that makes you a bit more hesitant to invest. But again, I think business investment is certainly moving in the right direction. It's just not back at that pace that we've seen in prior expansions. Okay, so consumption. So this is, I think, the most interesting and certainly the largest part of the economy, and maybe the most relevant to you guys, because I think you rely maybe quite a bit on sales tax revenue, if I'm not mistaken. So consumption, again, certainly moving in the right direction. We're forecasting right around 2.5% for the rest of the year. Typically at this point in the business cycle, we'd like to be above 3%. So a couple of reasons why we're not there. Employment. So we just reached our pre-recession peak finally. Right? I think in general our labor market feels a lot healthier. I think we generally just sort of feel like things are picking up. Right? We have fewer jobless claims. We have more job openings. A little bit stronger job growth. We're averaging, I think, just over 200,000 net new jobs every month. So I think that's really great news. There are just some sort of caveats that we sort of have there. I think these are the reasons why we're at 2.5% and not at 3.5% for consumption. And the first thing is unemployment, right? So when you look at that regular unemployment rate, that U3 rate, we're down to 6.1%. But this doesn't factor in that we have people who are part-time who want to be full-time. We have people who there are a number of people who aren't being counted as unemployed because they fall into that discouraged worker category, right? The people who sort of gave up looking for a job. And so this U6 category, this U6 measure of unemployment, takes into account some of those people, the people who really want a job but just happen to not look in the last 4 weeks. So I think when you look at it from that perspective, the unemployment situation isn't quite as good as sort of that headline number comes out to look at. So I think that's one piece. And I think, it is indicative that we do still have a lot of slack in the labor market. And so if you hear, the Fed Chair, Janet Yellen, come out. She always talks about this labor slack. That's what she's talking about. And I think this has a lot of implications for wage growth, right? So this is the employment cost index. The brown bars are wages and salaries. And so we're well under 2% year-over-year growth for wages and salaries. And that's under inflation. So essentially our wages aren't keeping up with even the price growth of what we buy on a day-to-day basis. And I think what we need is more job growth. We need fewer people who work part-time. We need people to come back. We need a little bit more bargaining power in order to sort of demand those wages, right? And I think right now we're still at that point where people actually feel that they don't really have the bargaining power with the with their employer to say at the end of the year, no, like I need a 5% increase or I need a 10% increase or whatever it is, right? I think now everyone's still at that point of, no, I'm still grateful to have a job. I recognize I'm replaceable. I'm not going to sort of rock the boat. And then of course, if you don't have wage growth, sort of disposable personal income is also at risk, right? So we're not having that much growth here, and of course this has implications for consumption and then also sales taxes. And then the last piece of sort of this consumption puzzle thing that I want to talk about is debt. Because I think it's really important. So, right, employment's moving in the right direction, just maybe not, we're still not quite there. Wages are a little bit low, and then debt. So this is household debt, consumer, credit cards, your mortgage, which is a big piece of it, relative to disposable personal income. So we hit this, we were at 125% of personal income at right before the recession hit, and now we've fallen below 100%. And I think the big question for us is what's an appropriate amount of debt relative to disposable income for you to hold? And I would argue that this is still too much. I think people who disagree with me point to this statistic and say that no, we're sort of at a record, we're sort of done deleveraging. So this here is the household debt service ratio. It's how much you pay every month. So principal and interest relative to, again, your disposable income. And so this is a record low levels, but I think the problem here is that the distribution isn't even, right? So the reason this fell so much is, yeah, people are paying down their debts, but a lot of this is an interest rate thing, right? So if you refinanced on your house, you saw a huge drop in your monthly payment, right? But a third of households don't own their own home, right? So they didn't get that big drop. You would argue that some of the drop, might be because people foreclosed or people, went into bankruptcy, so you also got rid of a fair amount of debt. But I think that we still have a large chunk of the U.S. population that is really saddled with a lot of debt, and they continue to have to pay down those debts. And therefore, we're not getting that much more consumption, and we're not getting those additional sales tax revenues. And then the last piece of sort of the debt thing is that the composition of our debt has changed over time. So the two points I want to highlight are in 2003, student loans were about 3% of total household debt. It's about $300 billion, and now we're over $1 trillion in student loans in 2013. At the same time, credit cards went from 8.7% down to 6%. And we could argue about the relative merits of paying down credit card debt, but overall from a consumption standpoint, if you want more consumption, it's probably not great. It's not a great sort of scenario when you have less credit card debt, right? We use our credit cards to pay things and sort of smooth consumption over time. So we can throw some of the debt now, pay it off a little bit later. But I think the student loan thing it ends up being problematic in a number of arenas and not just consumption. For example, if you have $100,000 worth of student debt, your standard payment's probably about $1,000 a month. And it's not insane to have $100,000 worth of student debt. I think average is about just under $30,000. So again, even that would be about $300 every month that you're paying. And you're right out of school, you're 22 years old. That's a lot of money to have to pay. So again, these are just some things that we've been seeing that sort of limit consumption, limit sales, and also to a degree that have a sort of limitation on the housing market, which we'll talk about in a minute. Which leads me to the point of mortgage rates. So about this time a year ago, right, mortgage rates spiked. They jumped about a full percentage point. And there was a lot of talk. I think a lot of people came out and said this is disastrous, and a lot of people came out and said no, everything's fine. We looked and we said it's still 4.5% is very low, right, for mortgages. That really shouldn't be preventing people from buying. I think the evidence shows that it did push some people sort of out of the market, and I think when you look at existing home sales, you see this big jump in sales, and then it tumbles, and now we're starting to get it bounce back again. I don't think it was quite this bad that jump in mortgage rates did all of this to home sales, because I think that this is being affected by a number of things. One, you can maybe argue about the weather. I think more importantly, investors have had such a large role in the home market. And what we saw was that sort of these investors piled in, and then as prices have gone up, as sort of the number of foreclosures have gone down, those investors just didn't see that buying homes were as much of a value as they've had them before. So we had this big pullback in investor demand, and then we saw this drop in existing home sales. So what I think is a little bit of a better indication of demand for housing ends up being new home sales. And you can see it's still basically record low levels, all the way back to the early 90s. And I think, underlying demand for homes is just still really weak. And I think some of this is debt problem. Some of it is that people locked into that really low mortgage and don't want to sell their house. And some of it's just uncertainty, right? If you're a little bit worried about your job, I think, even personally, right, I don't own a home, and I think it's really easy for me to say, actually, I just pick up and move. I'm a renter. I can move to New York, or I can move to California if I need to. But if you buy a house and if the housing market isn't really great, right, then you aren't as flexible. And I think in a sort of a weaker labor market, it probably is better for you to be a renter if you're not in a very stable job. And then I think moving forward, we look at consumer confidence to say, are people planning to buy a home in the future? And what we've seen is we saw this increase in consumers' plans to buy a home in the next 6 months. And it's kind of fallen off recently. And this is troubling for us that, I think when you look at the overall economy, you think, yeah, things are improving and we would expect to see more and more of those traditional home buyers coming back. But I think this number really suggests that that's not happening. And that we're sort of going to be maybe stuck at a plateau for at least a little bit. And the other thing I want to talk about is home prices. So it's big surge in home prices. And again, I think these are investors, and also sort of the implications of having all these distressed homes. So distressed homes foreclosures end up being really cheap, and they weigh on prices. And then as those sort of went out of the market, we had this big jump in home prices. So we're going to see sort of a moderation in home price growth moving forward, and I think we should expect to see this for a little bit. So depending who you ask, we're about 8% year over year. Don't be surprised if we fall below 5%. And then residential construction without underlying demand, we're not getting that much residential construction in the market, and this is our forecast all the way to 2018, and then we'll still be below, well below where we were in the pre-recession peak, and right about where we were in 2000 in terms of residential construction. And this has big implications, right, for the overall economy. So it's not just construction payrolls; it ends up being you buy furniture when you buy a new house, or you build a new house. So it's the flooring, it's the wood, it's the appliances, it's the copper that goes into the wiring, and so much of that ends up being made in America. These are jobs all over the U.S. and that has a really big ripple effect throughout. So this is extremely critical, I think, to the overall U.S. recovery. And I think the reason we're not getting to that 3.5% overall growth, it can largely be blamed on sort of this deficit in the housing market. Okay. Any questions about the U.S.? I know that's sort of rapid fire information. Burning desire for. US question. All right, so let's talk about what's happening here. Okay, so good news, North Carolina, from a growth perspective, 2.3%, right? Yeah, so 2.3% GDP growth in 2013, well above the US 1.8%. 0.5 is a big deal in GDP. So that's been really good news. You know, the downside is that that growth hasn't necessarily translated into jobs. So I said before that, you know, the US has reached its pre-recession peak in terms of jobs, but North Carolina hasn't, right? So we still have about a 50,000 job deficit in the state. And what happened essentially is that during the recession, the state lost many more employees relative to the US in terms of growth, and then growth in the recovery has been just about average. Again, in terms of employment. So we're still not there, but we're growing, I think, at a nice rate. I'm gonna flip around actually. So we're moving at a nice rate, and the gains that we've made in employment have been broad-based. So it's across industries. So the recovery isn't just concentrated in one or two industries; it's actually everywhere. And then the big one ends up being professional and business services, and this has been professional business services ends up being a little bit of a catch-all. So it could be anything from sort of administrative support, business support folks, but it's also computer systems engineers and sort of the higher paying, like a lot of tech jobs. And this has been, there's been high growth in both of those categories. So it's not just, when you see this in other states, a lot of this ends up being like temp workers and administrative people, and a job is a job, but that ends up not being so great for income growth. But in North Carolina, it's not the case. It's actually, it's pretty good. The one thing I do want to say about, you know, I think people are troubled by, you know, this gap, you know, from our pre-recession peak, because the unemployment rate fell considerably in the state. Right, we dropped, I think, almost 2 percentage points over the course of the year. And a lot of people are like, oh yes, this is great. This means that, you know, the employment growth has sort of accelerated in North Carolina, and it did. It's still growing. It's right around 1.7 to 1.9% year-over-year employment gains, which is right in line with the U.S. But we didn't see an acceleration, and the U.S. didn't see a deceleration. So the reason you have sort of this convergence that you see on that graph on the right of the unemployment rates is because the labor force participation rate in North Carolina plummeted. So people are dropping out of the labor force. So it could be because we, have, maybe older folks are retiring and feel better about their retirement, or, sort of on the downside, you have people who are discouraged workers, right? So these are people who want to find work that they can, so they just sort of fall out. I wouldn't read too much into that, but I just thought it was worth explaining why we had this big drop in the unemployment rate, and sort of to say be cautious about using unemployment rates moving forward, because you have a numerator and a denominator, and it does funny things. And when you compare it to the U.S., you compare it across regions. People like to use it, if you have a really low unemployment area, you're like, oh yeah, things are really going great. And then if you're in a high unemployment area, you say, no, it's all because of this labor force thing, right? But I think this is the better way to sort of look at things, right? Look at the growth and look at where we are compared to where we were before we sort of got into this mess. Okay, so regionally speaking, a fair amount of diversity here, right? On the upside, we have Charlotte and Raleigh, probably not much of a surprise. Durham and Wilmington were right about, Asheville and Wilmington and Durham, all around right around the state average. So the state average should be right around 108. Sorry, so I should explain what this graph actually means. So this is employment, and I indexed it to February 2010, which is the sort of the trough of total employment in the state. And so this should just show how much higher we are relative to our worst point of unemployment. And so again, Charlotte and Raleigh doing particularly well, right around average for Durham, Asheville, Wilmington, and then quite a bit worse for Hickory and Fayetteville. And I think there's some, and then here's sort of a graph for unemployment rates. So you can see, again, sort of the same situation, Asheville doing pretty well, Wake County, Orange, Durham County, and then Charlotte also doing pretty well. But I think it makes sense why you see this spread, right? And it has to do with where are the jobs coming from. So if you are in an area where you have a lot of office employment in the state is growing by 4% year over year. So Charlotte and Raleigh, where you have tons of people who work in office buildings, and you have tech and you have finance, things are going really well for you. If you were a place that has a lot of manufacturing, probably not that well. You probably see a much slower economy. And no surprise, right? So in North Carolina, the graph on the right, you see that's total manufacturing employment, right, basically dropped in half from the early 90s to today. And then on the graph on the left, you can see total gains in manufacturing. Again, it's right, it's pretty much flat year over year right now. And then the other piece I want to talk about is construction, because I don't think we talk about it enough. The deficit, so I said we're 50,000 jobs short in North Carolina, right, from our pre-recession peak. Construction is almost 80,000 jobs short, right? So the entire deficit of jobs can be completely explained by construction. It can be more than explained by construction. And so this, coupled with the problem with manufacturing, I think ends up creating a hollowing out effect. And this isn't unique to North Carolina. It happens to be a bit worse in North Carolina than it is across the US. But it creates a hollowing out effect for incomes. So if you work in construction, your average pay is probably about $45,000. But if you lost your job, where did you end up working now, right? You're either unemployed, or you probably got something in retail, you got something in food service, maybe even like home health care. And all of those jobs pay about half, right? They're low 20,000 per year on average. So this ends up being a reason why we don't see incomes coming back. So personal income, that when I show that wages and salaries, that they correct it so you don't have that effect. But in the state, in this state in particular, you really have this loss of manufacturing, this loss of construction jobs, and you have people either working high wage jobs, you have people working really low wage jobs. You sort of have this polarization. And the places I think that where you see construction bouncing back, and even to a smaller extent manufacturing bouncing back, you see those incomes coming. You see sort of those economies improving. You see this to some extent here, right? The Wilmington being so strong is a sort of a blip. It's volatile, though it is actually growing. But Charlotte has a ton of construction. Durham and North Carolina in general is actually growing relatively well. But Winston-Salem, Greensboro, all lower than year over year, and I think that's a little bit troubling. And so, like I said, I think that ends up being a weight on overall income growth. And not to say that you can see we have income growth, and I think we're going to continue to grow our incomes moving forward. It's sort of a reason why we're not reaching a certain potential rate. But we do have sales tax revenue. This sort of up and down, I think, is due to a change in rates. But 3.6% year over year growth is actually pretty remarkably strong, right? We're forecasting U.S. consumption to be about 2.5%. So having, or I think for 2013, we're only about 2.5%. So 3.6% for sales tax is quite a bit stronger than we're seeing elsewhere. And so the housing market in North Carolina, like I said, again, permits on the left is residential construction. We had this nice little rebound in the early part of the recovery, and now we've kind of plateaued and we're even maybe a little bit lower than we were a year ago. And we've been seeing this all across the U.S., and again, it's that demand for housing is low, and it's a bit troubling, and again, it has all those ramifications for the broader recovery. The one good thing that North Carolina has going for it is that relative to the nation, the home price boom and bust wasn't quite as severe here. So the number of people who are who have negative equity, people who owe more on their home than their home is worth, it's quite a bit fewer here. And then in addition, you didn't have sort of that, places like Florida and Arizona and Nevada sort of had this big drop off, and then they had this big jump up in prices, and now they're sort of seeing this waffling effect moving forward. In North Carolina, I don't think it's been quite as sort of heavily invested in, right? So there's more of a I think home sales here are much more of the traditional home buyer, the investors sort of pouring in and sort of muddling the waters, or muddying the waters. And it doesn't look like North Carolina home prices have moderated quite as much. So again, I think there are those traditional home buyers who are sort of staying put and hopefully continue to grow. And then just looking forward, North Carolina has actually proven itself to be, really good at population growth via migration. Right? So North Carolina has more people coming to it than leaving it, which is not the same, but we could say for a number of states. And so all Wilmington, Raleigh, Charlotte, Durham, all those are really strong rates. The U.S. rate is 0.7% for population growth. So all of those metro areas that see the strongest population growth, some of that is because their economy is doing well, but also their economy does well because of it also. So it's this sort of this feedback loop. And I would suspect that these are sort of the economies with the strongest population growth are the ones that are going to continue to perform well moving forward. These are the ones that are sort of winning at being able to attract people who from outside of the metro area, people that the businesses that are hiring, and then also it generates more, and so it attracts more people. But still, Winston-Salem and Greensboro, that's right around. Those are both, I think, right about 0.7. So also really not bad. That's right around the U.S. average. So I think looking forward, despite this this deficit in jobs, and I think the heightened sort of unemployment in the state, I think North Carolina is doing particularly well. I think we've done a great job of sort of attracting big name employers who I think that we're seeing a large trend of employers in higher cost states moving to North Carolina. I think North Carolina has done a really good job of being able to sort of capture at least some of those folks. And so I expect that moving forward we'll have a little bit of an acceleration in employment growth. And I think that we should actually be able to sort of keep that GDP number, the GDP growth, a little bit above the U.S. average, at least for the next couple of years. Here's our forecast, and I'd be happy to entertain any questions. Not all at once. Yes.
On one of the North Carolina slides, you showed you guys were looking at 3.6% for sales tax growth. Is that
3.3 maybe?
3.3. Now, is that just for the upcoming year, or was that a projection to continue to go out?
That was Q4 over Q4
Okay.
for 2013. Sorry, I should have 2013. But yeah, I can't imagine that it should be much. I don't do an official forecast, but I can't imagine that it should moderate much below that. I think it should stay at least consistent with that. And it's been, for the last few quarters, it's maintained sort of that rate, which I think seems promising. North Carolina's been steady, but things haven't moved. When we look at other states, employment moves around a bit more. North Carolina's been nice and a nice, smooth employment growth, but it hasn't actually bounced around quite so much. So hopefully it stays that way and keeps going.
I have a question.
Yes, ma'am.
Do you withdraw commercial development? I see that you looked and brought up residential development. I understand the correlation, but do you ever look at the commercial component? What kind of things should that be targeted?
Yeah. Yeah, so the commercial real estate stuff is, the data is harder to look at because we don't get it by a whole state. It only comes from metros, and usually it's larger metros. So we get it by, you can certainly see it in Charlotte, you can see it in Raleigh, and then to a lesser extent in Greensboro. But outside of those areas, we don't see so much. No surprise in Raleigh and Charlotte, it's actually going particularly well. The ops, we're seeing some uptick in ops completions and ops construction. But in general, and I assume it's probably the same in North Carolina as it is U.S. overall. It's slow, and it's a couple of reasons. So for retailers, we're shopping online more and more, right? So there isn't as much of a demand for malls or sort of shopping, right? And addition, and then you have office, which has been sort of the one that's improving a little bit better. But we're, in general, I think, employers are making do with, people are sort of flexible work environments where you can work from home, squeezing more people into over previously larger areas. For example, I have 4 feet by 4 feet. Literally, my boss is right here. He could actually hit me, like without even it's just like that. So we're actually cramping like sardines. So Wells Fargo is not messing around with space. So like now we're just all of these in one tiny building. That one large room, but a lot of us, I guess, and then the last one is industrial. So industrial has actually been the best one. But a lot of that ends up being seen in energy states like Texas and North Dakota. Here a little bit we have seen it. So I think maybe like there's that intermodal facility by the Charlotte airport. We do have still have manufacturing and then the data centers that were being built in the western part of the state have all contributed to that. But generally, I think that commercial real estate, just like residential real estate, is still pretty low. And I think the employment numbers speak to that with the 30% less in the state. And I think it's like 25% less in Needless overall. Yes, sir.
Do you have data on what, I guess, the percentage that decline in labor participation is due to, I guess, natural retirement age? People with job retirement finally dropping out more voluntarily?
Yeah, no. So it's hard to tell, and it's been sort of a big debate among economists of, excuse me, because the labor force participation rate has been dropping throughout the U.S., right? And so the big question is, how much of that is structural? Where you have a big chunk of the population, the baby boomers, who are moving into retirement. So those people should drop out of the labor force, right? Labor force participation is measured by anyone who's over the age of 16, who is either employed, anyone who's over the age of 16, and then if you're in the labor force, you are either employed or actively looking for work. So it counts someone who's 90 years old, right? We think half of the decline is due to people sort of going into retirement. But we do think that other half are the people who are either discouraged workers, or you just need to, right? I mean, childcare costs are expensive, so keep your kid out of childcare and stay at home, whatever it is. But yeah, so we think it's about half. On a state-by-state basis, it's a bit harder to tell. But I would say as a rule of thumb, probably half and half. Anyone else? All right, well, thanks so much.